Hi guys, thank you so much for joining me in another video and welcome back to my channel. In this video we are going to talk about how you should evaluate whether you are better off buying or renting a home. Hi, I'm Fifi, a mum, engineer and consultant living in London, and I make videos about saving money, investing and understanding the economy to make better financial decisions. In the UK, the home is considered as our castle, and owning your own castle has been an aspiration, a life goal that many of us Brits strive for. Let me just sprinkle a few facts out there. The figures are actually quite similar to the US, where in both countries about 65% of people own the home. However, for young adults, the figures are not so comforting, and those at the age of 27 and born in the 1980s had a home ownership rate of only 25% compared to 43% for those born in the decade prior to that. In fact, mean house prices were 152% higher in 2015 than in 1995, and income only grew by 22% during the same period. Building a deposit can be quite hard for young people, and trust me, I've been there. This video should make us at least assess whether all the sacrifice that comes with building that large lump sum deposit as a down payment is even worth it anyway. So with all this hullabaloo, how should us personal finance folk look at economics of home ownership? The current average house price in the UK is approximately £240,000. So we'll use this as an example for the analysis of the maths going forward. So mortgages are made up of capital and interest. Capital is the amount borrowed to buy the house, and this is paid down over the life of the mortgage. The other component is the interest, and you can't really run away from it, which is the amount you pay to the bank for them lending you the money. I'll try and pop a table down here somewhere to show you what it would look like if you had a mortgage of say £204,000, which assumes you put down a down payment of 15%, and we have taken an interest rate of about 2.29%. So what you will notice here is that interest is front loaded, so up at the top. So you pay more in the early years as interest, though as time goes on, that mortgage balance reduces. And as you repay capital, you have a lower amount borrowed, and so the interest also decreases. And that's the first clue, guys. The longer you own your home, the cheaper it gets. And I'm resisting the urge to say time in the market, but there you go, I said it. So that creates some of the awesome advantages of buying a home. So if you compare rent versus interest, then the average rent in the UK is £985 and interest is £452. So if you're paying away cash, it's cheaper to pay interest to the bank than to pay rent to the landlord. And interest falls over time, and inflation erodes away the amount you have borrowed. Rent generally increases in line with inflation each year anyway. Again, it's cheaper to have a mortgage and financing over time than paying rent over a long period of time. Do bear in mind though, the total of capital and interest paid will most likely exceed rent, but you should think of the capital paid as forced saving, as with each payment you own more of your home, but you'll have less of your pay packet to keep, and so those nights out need to be controlled. Now with the current situation, those nights out seem like they were a lifetime ago. The forced saving rate is the mortgage interest rate, which is now the interest you no longer pay on the capital you have repaid. Basically, your forced saving rate is a rate of 2.29%, which is nice, but not as nice as investing return. In this example, you've paid £64,000 of interest over the term of the mortgage, but could have paid £400,000 in rent, as I'll show you here, with rent rising in line with inflation. There is a flip side, guys, which is the benefits of renting, and there are personal finance advocates out there that also talk about the benefits of renting, so you can go find those out if you want more deets. And with home ownership, includes all of the associated costs of home ownership, so repairs, taxes, maintenance, which you as the homeowner are responsible for, and if you're a tenant, you just call the landlord up to have it fixed. You should factor in all of these costs in as well when working out what the monthly cost actually is. Finally, you do need to evaluate the opportunity costs, and really there is one big one which is foregone, and that's earning of your down payment or deposit, which could be earning returns in the market instead. The other part to consider is the forced savings. As you pay down capital and also the property rising in value, neither of which translate to cash every month but are realised when you sell the property. So they do form part of your net worth and your balance sheet. There's a lot here to think about, I know, and a lot of numbers to calculate, but Graham Stephan, the the king of all of this, has a video on his channel which looks at the calcs in a little bit more detail. I don't think the numbers are entirely realistic, but by the by, the method is pretty solid, and if you wanted to work through it on a spreadsheet, that would be a great place to start. Let's talk about renting and how does that stack up then. In the example that I've just discussed, we have shown that rent is pretty much double that of any interest component, and that being said, your deposit, which is now saved, would generate over time £300 a month in the long run. And then when you factor in insurance and maintenance on the home buyer side, you'll see that actually renting does work out, assuming say £250 to £300 of insurance and maintenance per month on a pure cash flow basis. So rent is about £985 less the investment gains £300, which is £685, and home ownership interest is £452 plus the £250, which is £700. So this is very simple and excludes all the clever stuff like unrealized gains, appreciation, forced savings rate, just some analysis on pure cash flow basis. However, and I just need to put a however out there, but when you do factor in the implicit and the non-cash flow items and assess them, then home ownership outweighs renting, especially when you're in your own home for a long period of time. So those sunk costs are a little bit like taxes, legal fees, etc. They're all amortized over a longer period of time, and that's what it boils down to. Rentals provide that easier cash flow and flexibility to move around. If you are planning to live in your home for a while and put down the roots, hands down, owning a property will make you wealthier, and so finding a way to build that deposit will be worth it in the end. Imagine if you had all of the and were able to collect rent on your property as well. Well, that's the beauty of real estate investing. You get to generate cash flow on your home as well. But if you're interested in watching a video on the general outlook of the UK property market, I have linked a few here. But until next time, that's all. Cheers guys, bye.